Hi everyone, welcome to YouTube's most transparent portfolio, the Bought While Waiting Show, where I share my journey towards 3.5 million US dollars. In today's episode, I'll share how I beat 99.5% of Tiger Broker users globally by portfolio returns. This includes a breakdown of my holdings as well as my stock selection process. Before I start, it's important to mention that I'm not sponsored by Tiger Brokers, and they just happen to be one of the brokers I use that has this feature that allows comparison with other global users. I started investing in 2021. Up till today, that's about 4 years. Over this time, I clocked 126% in returns. And it is this metric over here where I noticed a few weeks ago, it changed from 99% to 100% for the past 4 years. I was very curious what that meant because 100% should mean I'm ranked number 1 in the world. So I sent Tiger Brokers an email and I was told that there is actually a rounding error, and in fact, my account's return rate currently beats 99.5% of global users on Tiger Brokers. If you've been following my channel for a while, you know I run a really concentrated portfolio of stocks. Here is a screenshot of my current holdings on Tiger that have resulted in my top 0.5% performance. All 5 companies have done well and 3 of them have more than doubled. Apart from these 5 companies, part of the outperformance against the other 99.5% of Tiger investors or traders was that during the dip of 2022, I invested very aggressively into the QQQ and it rebounded a lot thereafter. I also cut my previous losses in China and redeployed my QQQ into these 5 companies, which I intend to hold for a long-term horizon of 10 years and beyond moving forward, barring any changes to fundamentals of these companies. So the past transactions in the QQQ and China are something to take note of in terms of this overall 4-year performance. In the spirit of being the most transparent portfolio on YouTube, I'll also share screenshots of 2 other brokers where I spread my investments in. And these are Interactive Brokers and Moomoo. I started using Tiger and Moomoo at the beginning in 2021 because they were offering commission-free trades. Over time, I've been slowly transitioning to IBKR because it's far more reliable in terms of reputation. I foresee the bulk of my future cash injections will all go into IBKR. Now, all 3 brokers have the same 5 portfolio holdings, which are Meta, Exxon, Mercado Libre, Amazon, and Netflix. You might spot some odd stocks here and there in my screenshots of IBKR or Shop because these were free stocks given by one of the brokers in the past that I just haven't sold. But they are just 1 to 2 shares, so I don't consider them when evaluating my overall portfolio selection performance. If we sum up the total investment fund across 3 brokers, the Bought While Waiting Fund currently sits at $386,278 US dollars. I have a personal goal of hitting 3.5 million US dollars in 12 years by 2037. So I'm still a long way to go, but I will continue to invest aggressively to get there. Over the past 4 years, the fund has achieved 319% on a money-weighted basis, which works out to be 47.19% per annum. This beats the S&P 500 and Nasdaq by a wide margin, but I'm still trailing behind Bitcoin, which has done exceptionally well this past 4 years. And in fact, I have a running bet with a friend who has 100% of his holdings in Bitcoin and MicroStrategy. The bet is that if I beat him over a 15-year period by money-weighted returns, he will have to buy me a 3 Michelin star meal. If I lose, I have to do the same for him. Now, I don't want to open a Pandora's box this episode by discussing the pros and cons of equities versus crypto. So maybe let's leave that for another day. For today, I will focus on unveiling the 8 most important stock selection criteria that got me to the top 0.5% of all Tiger investors globally over the last 4 years. The first criteria is to focus on companies within your circle of competence. For me, this includes tech, advertising, and e-commerce, which are areas that I've worked in before. Now, the odd one out here is luxury because of my past experience where I previously consumed a lot of luxury products and I have an understanding of the different brands. As a long-term investor, I think this criteria should be the first and most important one, where you narrow down the entire universe of companies to a handful that you have an edge in. Everybody has different circles of competence. The important thing isn't how big this circle is, it's staying inside it. So an example is Nvidia, which has obviously made the headlines since the start of this AI hype cycle. Although Nvidia is an impressive company, but I know nothing about GPUs or the semiconductor industry. And I know this because I've never worked firstly in hardware before. I've only been in software throughout my tech career. I'm also in this Telegram group where people are discussing specific stuff about TSMC manufacturing, how many nanometers chips are in production, what are the order cycles. And so when I observe these discussions, I realize that these are way out of my league. And it's not something I feel I can have an edge in. Now, one bonus point I'd like to add is that I believe it's possible to expand your circle of competence. But you have to be really passionate about the business you're looking to learn. One example that piqued my interest was Exxon, which is the second biggest on my portfolio at 20% currently. Although Exxon is in the defense industry, which is a market I've never worked in before, I found it easy to understand its business because I'm super interested in their products, tasers, body cams, and the drones. I just think that as a guy, as a geek, some of these products are so cool, so it really motivates me to want to learn more about them. Now, unfortunately, I don't share the same passion for semiconductors or GPU chips, so I'm not able to get into the whole NVIDIA or TSMC game to a very granular extent as a result. One bonus thing I'd like to add about Exxon is that they are increasingly not just a taser company, but now also a cloud company through the evidence.com system, and also in a way an AI company through their new AI products like Draft One, which translates languages through their body camera, helping police officers to communicate with people in different languages. So I can tie in some of my understanding of software and the cloud from my work, making Exxon sort of a good fit for me in my circle of competence and easy to expand in that sense. The key advice I have here is to figure out where your strengths and passions are. And don't buy a company just because everyone else is buying it out of FOMO. Because when the stock falls, which I guarantee you it will at a certain point, you have to know enough to decide if this fall is short-term or a long-term systemic risk based on your understanding of its underlying business. The second most important criteria I look for is whether a business has a moat or a product that's unique and difficult to replicate. Quoting Buffett, a moat is something that protects the business like a castle away from its competitors. Now, if you've read Peter Thiel's book, 0 to 1, which is one of my favorite books, he also mentions that competition is for losers, in the sense that you should aim to create products that are so unique and so hard to replicate these products to the extent that you have no competition. The quickest way to tell if a business has a moat is to compare their gross margins to their most direct competitors. For Meta, Exxon, and Netflix, I've listed their closest competitor and you can see the difference in the gross margins. With Amazon and Mercado Libre, it's a bit difficult to compare them because they have multiple parts to their business and are in a class of their own. I prefer to assess these two companies' moat on a more qualitative measure, which I'll share shortly, but their gross margins are already excellent at 44 and 52%. The simplest reason why gross margins provide a clue to a moat is because if customers are still buying your product in spite of the high premium, it just simply means that you've created a product that's so unique and they are still willing to pay up for your product over a cheaper competitor's alternative product. Now, the easiest example to showcase this is obviously Nvidia, that commands a premium of 75% gross margins compared to their next most direct competitor, AMD. Because as we know it, GPUs that they create are way more performant for training LLM models in the current AI paradigm, owing to the CUDA ecosystem and also NVLink. Sometimes you also get companies that have much lower gross margins like Airbus at 15%. Low margin businesses are usually in mature industries where there's a lot of competition. So it's no longer about product differentiation, but instead it boils down more to management execution. For instance, between 1972 and 2002, the best performing US stock, believe it or not, was actually an airline stock that compounded at 26% for 30 years. Even though the airline industry is super commoditized and even Buffett himself dislikes airlines. The point I'm highlighting is that for companies that rely more on management execution ability as opposed to product differentiation, it's still possible to be winners in a crowded industry. But personally, I avoid crowded industries altogether and lean towards the path of least resistance. So I generally look for high margin businesses with differentiable products or moats where they have almost no competition. So it really boils down to what sort of investor you are. The second consideration to assess a company's moat is to look at it from a qualitative perspective. In other words, its business model and its qualitative attributes. This, in my opinion, is a far better gauge as a long-term investor. There are two parts of how you can assess a business. One is the short to medium-term finances every quarter when we read the reports. Is the company on track in terms of revenue growth, margins, earnings, etc.? And then you decide if their business is on track. The other longer-term piece, which I feel a lot of investors miss out on, is how sustainable said business model is in the very long run. Now, you can do very well for a few years, but if your business model is vulnerable to disruption, then the long-term terminal value is called into question. Because if your business model is threatened in the future, then it just simply won't be able to produce the cash flows decently in the future to justify today's stock price when we discount it backwards. This longer term piece is what I really focus on. And the qualities that contribute to such a long term moat include, for example, network effects in Meta's case, ecosystem stickiness and patents in the case of Exxon, barriers to entry in the case of Netflix, where you have to be able to spend billions of dollars for content production. Legacy players in this case, in the streaming wars like Disney, are disadvantaged because while they are trying to ramp up their streaming, they have to also divide attention to unwind their legacy cable TV businesses, and at the same time also have to manage their other high capex projects like their theme parks. For Amazon's AWS, switching costs are an example of a huge moat, where you have technical costs and transfer out fees if you switch providers. Amazon, of course, also has economies of scale in its online e-commerce business with its massive logistics infrastructure, similarly for Mercado Libre in Latin America. The third criteria I have when selecting stocks is to also ensure that they are riding on a larger secular trend. Now, for instance, with Netflix, it rides the trend of streaming TV taking over legacy cable TV at an increasing rate. For Amazon, we have an increasing trend of on-premise servers transitioning to the cloud, which benefits AWS. For Mercado Libre, we have a high growth region in Latin America that's still in the early stages of explosive growth in e-commerce. It also helps that President Milei in Argentina is introducing reforms that are influencing the region to open up in a positive way. If I sum up each of my 5 core positions, every single one rides a trend. You don't want to participate in a sunset industry like printed media or traditional travel agencies, for example. You have to be clear what underlying trend you are riding in order to increase the odds of success for your investment. Because as the saying goes, a rising tide lifts all boats. The next criteria is consistently growing revenues over the long term of at least the last 5 years. The revenue graphs of good companies should all go to the upper right over time. You also want to make sure that the revenues 5-year average are at least growing at mid-teens level. Of course, the higher the better. Let me explain why consistently growing revenues are important. If we look at this investigation by BCG, and Morgan Stanley on historical S&P 500's stock performance. They found that over the long term, revenues were the overwhelming reason driving stock price movements, whereas over the short term, the multiples valuation of a stock matter more. Now, because I am focusing on investing over the long term, I care much more about the fundamentals of the business, such as its revenues. Consistently growing revenues are important because they are in fact a leading indicator of what will ultimately accrue to investors. What do I mean by this? If we look at the income statement of any company, it always begins at the top with the revenue. Then this revenue gets eaten away by a bunch of costs, capex, taxes, and more. And eventually what's left is the free cash flow. Now, it is this free cash flow that can be distributed as value to investors in the form of either dividends or share buybacks, which accrues as value to us as investors. So in summary, how well the revenue performs at the top of this funnel has real implications and is a leading indicator on what eventually reaches us in terms of value. And so because the market is always forward-looking, long-term revenue growth becomes sort of an early gauge whether the company still has a promising future worth investing in. Now, of course, there are tons of other financial metrics such as operating margins, operating cash flows, debt, etc. But I won't dive into this because the purpose of my 8 criteria is to quickly screen companies that are worth looking into in the first place. The 5th criteria in my stock selection process is management. At the very top is integrity. I draw a red line against investing into companies that have demonstrated any form of accounting fraud before, such as the case of Enron or SMCI. Because if management is capable of cooking the books, then you can no longer trust the earnings reports that they release or anything management says for that matter about the future prospects of the company. So this is an immediate strike off for me in terms of my screening process. Now, the second trait I look for in management is skin in the game. Simply put, how much of their own personal net worth is invested in the company shares. Now, I won't dive too deep into this one, but if you look at my past videos for each and every one of my investment, I perform calculations where I determine or estimate if the executive chairman or the CEO of the company has at least 50% of his personal net worth in the company's shares. Because we want them to be in the same boat as us investors. As Munger always said, show me the incentive and I'll show you the outcome. Every one of my investments have a CEO or a chairman with massive skin in the game. Next, I look for what I call soul in the game. What this means is I want to know the inner motivations for why a CEO is running the business apart from monetary reasons. I'll give you an example. Mark Zuckerberg, in an interview last year, when he was asked why he didn't sell Facebook in the early years for large sums of money. His response was, after I sell it, what am I going to do with the money? I'm going to end up building something else instead. So I might as well just carry on building this one. The idea here is I want to look for management that have a deep-seated passion for what they are doing beyond just the monetary gains. Most of the time, we find this in founder-led companies. Why is this important? Because we want companies like Steve Jobs, Bezos, Mark Zuckerberg, who are willing to take short-term capex risks and criticism by Wall Street in order to invest for the very long-term horizon to remain nimble and innovative. We want to avoid managers who don't have an owner and long-term risk-taking mindset and are just playing the quarterly earnings game of optimizing short-term numbers. This is the reason why every single one of my investments is still currently run by a CEO or at least has an executive chairman that is the founder of the company. The next management attribute I look for is management's character. Are they egotistical? Do they talk with a lot of fluff in interviews? I can think of at least one CEO of a software company that's been recently making the news a lot. And even though his company has performed exceptionally well financially, whenever this CEO speaks, I get an allergic reaction because everything he says is super fluffy and makes no sense to me as an engineer myself in technology. Now, I see this as a long-term risk where the CEO is playing a game of smoke and mirrors. Now, they may do very well, don't get me wrong. In the short to medium term, if you are just going in for the short term, for a quick ride, in hyping up the market, this is okay, I guess. But in the long term of several years out, when the tide finally goes out, in the words of Buffett, we will see who's been swimming naked. So I have my doubts on the sustainability of flamboyant or egotistical CEOs, and I prefer a much more grounded and humble CEO who is heads down focused on executing more than smoking fluff. The next management character that I look out for is whether the CEO has focus. Does he have a lot of side businesses or endeavors that distract him from running the core business? Because I believe that there's only 24 hours in a day, and if you want to execute with exponential impact, you have to have undivided focus on the business. One of the lines that is most memorable to me in Peter Lynch's book, One Up on Wall Street, was when he said, "What's the story?" in referring to deciding whether a company was worth investing into and the general reason behind investing into it. Now, I was inspired by this line, and I thought about it for really long and sort of evolved it into my own version, which is, what's the next story? In other words, apart from the current growth story of the business, does it also have optionality in other lines of business that it's investing into? And are these options moonshotty or significant enough that they can move the needle if they do come into fruition? Or are there other explosive catalysts, for example, being beneficiaries to the current AI cycle where it can positively lift earnings in the future? The idea is that if I'm going to beat the market, I want much more than just the current core business trudging along. I have to see some future plans on top of this, such that we get spurts of explosive returns as we hold the company in the portfolio over the long term. I think it is these catalysts that can significantly contribute to outperformance over the market. Here, I list every qualitative optionality and growth catalyst for the companies in my portfolio. Now, I won't go into detail of each and every one, but if you are interested, you can look into some of my past videos. There is one important caveat I want to point out, which is that you have to first ensure that the businesses you pick in the very first place have a stable core business that is already providing enough sustainable cash flows to fund all these potential optionalities. Now, I'm going to ruffle a couple of feathers here and just be a bit more honest. If you take an example like Tesla, for instance, the core EV business at the very moment isn't doing very well. So even though FSD has tremendous potential to do well in the future, I've personally avoided investing into Tesla because of this caveat rule that I have. The next criteria is quite controversial. I actually look to see if the stock performance over the last 5 to 10 years has been on a general uptrend. Now, I know what you're thinking. Past performance doesn't represent returns, but you've got to believe at some point that the stock market over a long-term horizon of 5 to 10 years and beyond represents, in a sense, the net collective thoughts of its market participants. So if a stock struggles to perform over such a long time, then this criteria serves as a final checkpoint to ask, is there a catch where the stock isn't performing? Am I missing something in my screening process about the company that warrants further investigation? For example, if we can take a look at the stock chart of a company like Adobe, we can see that over the last 5 years, it has been pretty much flat. Now, if you've been following developments with generative AI, you know that every time OpenAI or Google releases image video generation tools like Sora or Veo, Adobe takes a big hit, because it calls into question whether Adobe's moat in its design software business is vulnerable to disruption. Now, I'm not saying that Adobe will definitely succumb to disruption in the future and be replaced. But if I were Adobe, I would much prefer a world where generative AI never happened in the first place, so that my moat remains 100% intact. Personally, I avoid companies that face such potential headwinds, and prefer to ride on direct beneficiaries of long-term secular trends in companies that do prefer for such innovations to happen. This is my philosophy, which I call the path of least resistance. And so this final checkpoint serves as a sanity check to see if you've missed anything up to this point. And finally, we come to the last criteria, which is, of course, valuation. Now, before I even talk about this part, I want you to realize that valuation only came in as my final criteria right after all the other considerations of the business fundamentals. Why is that so? Remember, Munger always said, a great business at a fair price is superior to a fair business at a great price. A lot of what we read in the news and on Twitter is about how expensive a certain stock is or how beaten down it is. But if we recall the earlier diagram I shared, where valuation multiples only matter in the short term in driving stock performance, whereas over the long term, it plays a decreasing role as you see with the shrinking yellow bars. And this means that as a long-term investor, you should always prioritize finding strong businesses before even caring about their prices. The main point I'm driving at is not to fall into the mean reversion value trap, because cheap shit is still shit. And so this brings me to the valuation methodology which I borrow from Brian Stoffel, where he values different businesses based on which part of the growth cycle they are in. So for early stage growth companies like Exxon, I look a lot into the historical price to sales ratio. For other companies on my portfolio, I look into things like DCF, reverse DCF, PE ratios, or price to free cash flow ratios. Now, one exception is Amazon, where I prefer to use price to operating cash flow ratios, because Amazon does this cyclical thing where they continuously invest capex into the future, so you get very erratic free cash flows that are hard to value. Apart from the valuation methods I mentioned, I also use a super simple technique, which is that I buy on pessimism. Where as long as a company I like dips by a certain percent from its 52-week all-time high, I buy into it. Now, I think valuation rules shouldn't be adhered to 100% like a dictionary. At the end of the day, who's to say the PE ratio or reverse DCF is a perfect way of measurement? Things always change in the business environment. Innovation happens, disruption occurs, a pandemic can happen. So even projecting out 5 to 10 years is wishful thinking in my opinion. I tend to find simple methods like buying on bad news just works without overcomplicating things. And so if you think about it, there are at least 4 opportunities per year when you can buy a company, as long as you wait patiently for them. And these are the 4 quarterly earnings that happen every year. Because if you truly believe in a company's long-term fundamentals, then all it takes is any one bad quarter for you to get the opportunity to buy in on a dip. The question is whether or not you can be greedy when others are fearful. And so to end things off, I will let you in on my exact portfolio allocations as well as my simple all-time high dip rule. For my tier 1 primary portfolio, I usually buy on 10 to 15% dips from the all-time high, while also assessing all the other valuation metrics that I mentioned earlier. And for my tier 2 watchlist stocks, these are slightly less explosive growth companies where I seek an even bigger dip of 25 to 40%. Because the idea is that I am compensating for the less explosive growth by juicing up some of the initial returns via mean reversion from a significant dip. Another reason why I have this separation of 2 tiers is because of the opportunity cost of capital. Tier 2 companies on my watch list have to fight with opportunities in tier 1 companies because every dollar I allocate into tier 2 is one less dollar I have for tier 1 companies. So the dip has to be so big in tier 2 companies and the pessimism so big that I can't ignore it when considering opportunity costs. I hope you enjoyed this episode, everyone. Until next time, thanks for watching.